friends, starting with it, the next problem to compute for us is, we'll just read out the liabilities and asset side. Capital and reserves, same is there. So capital and reserves 355, profit and loss account credit balance 7, loan from SFC 100, bank overdraft 38, creditors 26, provision of tax 9, proposed dividend 15. Asset side, net fixed assets 265, cash 1, receivables 125, stocks 128, prepaid expenses 1, intangible assets 30. Your total amount 550 in your liabilities and asset side, the balance sheet. So we need to compute here first your proprietary ratio. So friends, proprietary ratio is also known as your equity ratio, your net worth ratio, your shareholders equity ratio. Okay. So what does it indicate, or what does it show? Well, it simply shows the capital structure of a company. Also, it is used to see, why it is used to see how the company has been invested the capital. So in percentage terms, it's been showing how much percentage of capital or equity is involved here, and how much is your borrowed fund is involved. Okay, then if suppose higher the ratio, higher the rate of proprietary ratio is there, that means is considered risk free, it's considered as safe, or you can say it's good or better. But too extreme high is considered as inefficient or improper use of your financing or improper use of funds. This is the main indication of it. So we will just start with the formula. Proprietary ratio is equal to shareholders equity divided by your total assets, or you can say as your tangible assets, because most of them are doing total assets minus your intangible assets. They are deducting intangible assets. Anyway, the formula is same. So shareholders equity divided by your total assets multiplied by 100, or your tangible assets. We will just see the formula, shareholders equity. So what is shareholders equity here, friends? Capital plus reserves in the liabilities 355. Then your profit and loss account credit balance is 7, minus your intangible assets is 30. So you will get as 362 minus 30, that is your 332, divided by your tangible assets. So what is tangible assets, friends? In the asset side, 550, total amount is 550. So we will just 550 minus your intangible, that is 30. We will get as 520. Thus 332 in the numerator divided by 520 multiplied by 100, you will get a 64 percentage as your proprietary ratio. So friends, what does it indicate? If your equity ratio is 64%, then 64% of assets of a company is contributed by equity or equity holders. Rest are from other capital, or you can say other borrowed funds and other borrowed funds, and borrowed funds. Next comes here to compute is your net working capital. Net working capital, friends, the formula is your current assets minus current liabilities. So what is current assets here? So your current assets, first see your asset side 550. 550 minus your intangible assets 30, you can minus it, minus your net fixed assets 265. The rest all is your current assets. So current assets is 255 minus your current liabilities, which is 88. How come 88, friends? In current liabilities, 550 is there, total liability is your 550 minus your loan 100 minus your capital 355 and your profit and loss account credit balance 7. So 355 minus 100 minus 7, you will get a 462. So total liabilities is 550 minus 462, you will get as 88. Therefore 255 minus 88, you will get as 167 as your net working capital. Next is, suppose friends, if the net sale is 15 lakhs, is INR 15 lakhs, then what would be the inventory turnover ratio in times, or stock turnover ratio in times? We can calculate here in times, in days, in months, in years. So here in times we need to compute. So the formula here with is stock turnover ratio, na friends. So what does it indicate? It indicates simply the velocity with which a stock turnover or a inventory turnover is turned over, or you can say it's produced and it's ready to be sold or to be replaced. Okay, so they are having number of formulas to compute. The first formula is here to calculate is cost of goods sold divided by your average inventory. Cost of goods sold, that is sales minus gross profit plus your gross loss. But if this is not given in the above problem, you can take as other formula opening stock plus purchases plus your direct expense, that is wages, freight, carriage minus your closing stock. If this also is been not given, in that case, in absence of the required information, any one of the formula may be substituted, which I was just saying you. Inventory turnover ratio is equal to net sales divided by average inventory at cost, or you can take as net sales divided by average inventory at selling price, or also you can take as net sales divided by average inventory. I will just repeat it, friends. It's very important. Stock turnover ratio. Stock turnover ratio can be calculated as cost of goods sold, COGS, divided by average inventory. It indicates only the velocity with which a stock has been turned over, like it has been ready for finished goods, it's been ready to be sold or to be replaced. So cost of goods sold can be arrived at or derived as sales minus gross profit plus gross loss. If this is not given in the problem, you can take as COGS is equal to opening stock plus purchases plus direct expense or wages, indirect expense, wages, carriage, freight will be coming minus your closing stock. If these two are not given in the above problem, in absence of these two or the required information, any one of the formula may be substituted. The answer will be the same. Just apply the concept. Inventory turnover ratio is equal to net sales divided by average inventory at cost. This you can take. Or net sales divided by average inventory at selling price. This also you can take. Or net sales divided by average inventory. Simply we will take here now net sales divided by average inventory. So friends, what is your net sales here? 15 lakhs. So 1500 divided by your average inventory. Opening inventory is not given. Closing inventory directly is given. So 128. So 1500 divided by 128, you will get as 12 times. That is approximately 11.71 is there. So 12 times approximately the inventory has been turned over or rotated during a specified term.